Okay, so hi there. Welcome to the third in our series of 6 online lessons and sessions thinking about the aspects of the coronavirus pandemic and the economic crisis. These 6 sessions are designed for Year 11 students thinking about moving on to A-level economics in the autumn of 2020, and our aim is to think about some of the major economic issues surrounding the crisis that is all around us. In this session, we're going to think about the risk of depression, economic depression, and also think about how government and the Bank of England in the UK context has tried to prevent the economic downturn becoming a major slump. So this is the third session out of 6, and in the next sessions we'll look at behavioural economics, the economics of inequality, and the extent to which the pandemic might actually improve and change our economy in the future. We're living in a great age of uncertainty. This chart shows an index of economic policy uncertainty, essentially the number of times uncertainty is mentioned in leading financial newspapers. And you can see how significant the upturn has been in people worried about the future for both their jobs, their families, and for the economy as a whole. It's interesting looking at Google searches. This is from Google Analytics. Index of Google searches for the word recession. When the index reaches 100, that's the highest number of Google searches recorded for this particular term over the period, which is in this case from 2004. And you can see the number of searches for recession almost matching that during the previous financial crisis 10 years ago. And here's a word that's entered our vocabulary in recent weeks. The word is furlough, barely searched for on Google from 2015 onwards until the start of March, in the middle of March in 2020. So a new vocabulary is entering our understanding of the crisis. It's important, I think, to understand the difference between a recession and a depression, and it might be worth pausing the video at this point to maybe do a quick bit of internet searching to find out the difference between recession and depression. An economic recession, to most economists, is basically when a country, an economy, experiences 2 consecutive quarters, or 6 months, of negative GDP growth. In other words, the size of the economy in terms of spending and output actually contracts for at least 6 months in a row. And that's a recession. A depression is worse. What do you think a depression is? Well, a depression is a period of time when there is a persistent and severe fall in both output and jobs. Normally, GDP of a country has to fall by at least 10%, and the downturn has to persist for at least 2 years. Many economic historians actually say that the line between recession and depression can be measured by what happens to jobs, and in particular, when unemployment rises above 10% of the labour force, we call that mass unemployment, and stays above 10% for several years. So a recession is a different order of magnitude. And if we think about the Great Depression in the United States in the early 1930s, this was a depression of production and incomes and spending with severe economic and social consequences. The depression itself lasted over 40 months. There was a near 30% fall in GDP from the peak to the trough. Industrial production fell by nearly 1/2. Share prices fell by 80% from their peak. And the increase in unemployment as a measure, measured by the percentage of the labour force, the rise in joblessness was nearly 25%. Indeed, this chart shows the rate of unemployment in the United States from 1929 onwards. See how quickly that rate of unemployment increased during the Great Depression. I mean, it fell back later as the stimulus policies started to kick in, but this was clearly a huge moment in the economic history of the United States. More recently, we can take Greece as an example of a country that has suffered an economic depression. Take a look at this chart, which tracks the level of their real national output. In other words, national output adjusted for price changes, measured in millions of euros, and this is data for each quarter of the year, so there are 4 data points each year. And Greece was growing pretty quickly in the mid-1990s and into the first half of the noughties. But then, of course, the economy suffered a severe downturn. Output fell very sharply by more than 20%. And if you think about where Greece might have been had their economy continued to grow, had there not been a depression, you can see that there's a potential here for a permanent loss of output in the Greek economy. The Greek depression is something that many governments around the world will be hoping to avoid in the current crisis. A fall in output of that scale, of course, leads to a significant increase in unemployment. Take a look at this chart showing the percentage of the labour force in Greece out of work from 1998 onwards. The rate was falling from above 10% to about 7% in 2008, but then look what happened as the economy sank into the recession, followed by a depression. Unemployment peaked at over 25% of the labour force, although the positive news is that the rate has come down since. And if you're young in Greece, the risk of unemployment even higher. This chart takes the unemployment rate just for young people aged between 18 and 24. And you can see that the rate increased from 22% in 2008 to nearly 60% in 2013. Again, it's come down, but notice the rate is still 40% youth unemployment in Greece. Think about the scarring effects where young people are out of work often for a long time of that kind of magnitude. So this first video has looked at the level of uncertainty in the economy and the extent to which a recession is both inevitable and could lead to depression. In the next video, we'll explain how a depression can actually happen and why those risks could be pretty high.